So because the FX market is traded 24 hours a day, there are certain times where market liquidity thins out, but at the same time, there's times a day where market liquidity is at its peak, and certainly if we're looking for those high level of volatility, we certainly want to pick the hours where we see a lot of liquidity as well as a lot of volatility flowing through. And at the same time, I'm going to go over some technical indicators as well as some technical strategies that we've tested out at Daily FX, and certainly there are some caveats to all of them, even though sometimes they are profitable given certain market conditions. So the first thing I want to go over is with market volatility. So for those of you that are not aware of this, this is one technical indicator that I look at every day, which is the average true range. And basically, the average true range is just a moving average of the true range of a given period. So typically, I like to use a 14-period ATR, and that's typically by definition, and I just know that a lot of market participants use that, and that's why I like to look at the same thing that everyone else is looking at. And basically, all it is an absolute value of today's high and yesterday's close, and it's also today's low and yesterday's close. So just by looking at the ATR, we can kind of gauge of how much does this one currency pair move in one day. And just by knowing how much it moves, we could certainly set a better target or more of a realistic target of what we can expect. And it all depends on your type of trading style, because when I'm trading the news, some things I would look for is maybe just a 20-pip gain. Some of you might actually look for a 50-pip gain. So it all really depends on your trading style, but by using this, it just helps to gauge overall volatility in specific currency pairs. So taking a look at what's happening with the ATR, and here's just a quick example of what happened with the euro dollar. During that financial crisis period back in 2008, we actually saw the ATR jump all the way above 300 pips, and that's when we really saw a lot of movement in the exchange rate. And typically what we expected on days during that financial crisis is we expected euro dollar to move at least 300 pips a day. And certainly that gives a lot of room for us to make money, but at the same time, it really raises the risk for losses. So one thing that we clearly see here in the ATR is from above 300, it's moving all the way down now. In 2008, it actually was holding, in the first half of 2009, it was holding right around that 200. But one thing we see is it's actually tapered off, and it actually peaked around that 150 pip level. But now it's starting to taper off even more, and right around, I took this actually last week, and we're seeing more of a 120 pip range right now that the euro dollar is holding on a day-to-day basis. So now back to spreads. So here's a quick table that we have that we compiled, and this is all the data that we got from FXCS. So here's basically the spread that we have between the bid and ask, and basically one thing that we clearly see here is the spread to bid. It's relatively low as we trade more major currencies, but at the same time when we look for more exotic pairs, and one thing that's really surprising here is we see a lot of our traders, our retail traders, they actually really favor the pound yen. But one thing that we can see is pound yen is relatively high on that cost list compared to other pairs such as the pound dollar or even the euro pound. So, just by taking a quick gauge